October 9, 2002, Nasdaq 100 dropped a whopping 78% since its peak due to a stock market bubble crash caused by excessive speculation on internet stocks, which led to the downfall of numerous internet companies. It's early 1993 and the internet is sloppy. Revolutionary breakthroughs such as sending data around the world and the developments on World Wide Web were only accessible to tech scholarly people, due to which only 2.3% of the US population was online, which was only until September of 1993 when Mosaic, the user-friendly and graphical browser, was launched. Suddenly, the internet wasn't so hard. Web traffic increased 1000% within just a month's time, and between 1990 and 1997, the percentage of households owning a computer in US increased from 15% to 35%. This marked a shift towards an economy based on information technology (IT), and various new companies were founded. Various changes in taxation schemes, reduced interest rates and reduced capital gains taxes allowed people to perform speculative investments. That's exactly when Netscape Navigator, a new and modern browser, was launched, and it was a grand success. Even though the costs were exceeding incomes, the company's founders decided to cash in on the success with an initial public offering, and that was a colossal success too. Now normally, investors invest in profit-making companies, but with the whole world waiting to get online and the internet age at the dawn, people speculated the internet companies to skyrocket, so they bought the company's shares such that the company's market capitalization soared up to $2.7 billion in just a matter of minutes. This success inspired a wave of entrepreneurs and investors. Now every entrepreneur started an internet business ranging from food delivery sites, search engines, auction sites and whatnot. Now these companies did not make profits as their costs were higher than incomes. Still, they kept pouring in capital trusting the internet. Investment banks, which significantly profited from initial public offerings, fueled speculations and encouraged investing in technology. With the capital indefinitely flowing, people kept investing and companies kept expanding without profits. With confidence that the companies would turn profitably in future, many investors were ready to overlook traditional metrics such as price to earnings ratio, leading to a stock market bubble. Between 1995 and 2000, the Nasdaq Composite stock market rose 400%. The bubble peaks with the spread of rumors of an internet calamity dubbed as the Y2K, a calendar bug that threatens to destroy technology as we know it. People believe that the arrival of the year 2000 will trigger this calendar bug and destroy all internet company businesses. To avoid Y2K, companies started upgrading their computers with gargantuan amounts of capital, attracting more investments and pushing the market into outright mania. Qualcomm's shares grew up to 2619% in 1999 alone. People started leaving their regular jobs to become internet company and stockbrokers. As more internet companies started battling for growth, they started feeding on each other. They had to pay competing sums for advertising to attract investors. On Friday, March 10, 2000, the Nasdaq Composite Stock Market Index peaked at 5048.62 points, a bubble 200 times the size of underlying earnings. While it took the index only 5 years to rise over 500%, it would take only half of it to undo it all. The federal government was planning to tighten monetary policies, and after crazy spending, people did not require so much online companies. On March 13, 2000, it is announced that Japan has entered recession and Nasdaq slips into its fourth largest dip ever. This spooked the investors and made them to rethink their investments. Investors questioned the internet companies that whether they would survive without their investments, and the answer was obviously not. By June 2000, .com companies were forced to rethink their advertising campaigns since promised growth rates failed to materialize. .coms found themselves burning through cash, and within months, companies that had reached $100 million in market capitalization became worthless. Investor confidence was further eroded by various accounting scandals and the resulting bankruptcies, including the
Enron scandal, WorldCom scandal, and the Adelphia Communications scandal.
On March 2001, the US is on recession, and by October 9, 2002, the Nasdaq 100 had dropped to 1,114 points, down 78% from its peak. Over 4,50,000 IT jobs were lost, and it took Nasdaq 15 years to recover. More than half of the internet companies vanished, and the others became a fraction of what they were before. Yahoo, Pets.com, and 360 Networks are some of the notable companies that suffered losses. And as for Netscape Navigator, that kickstarted all of it, lost its market share to a program launched a week after its IPO, and that program was the Internet Explorer. This is how the internet boom collapsed world economy. Like the video if this video was informative, share the video if you feel like it, consider subscribing if you are new around here. Until next time, ta-ta!